we've got a busy week coming up from both a top-down and a bottom-up perspective. From the macroeconomic point of view, investors' attentions are starting to turn towards the next meeting of the US Federal Reserve, which is slated for Wednesday the 11th of December. Although markets are putting a 98% chance on Chair Jay Powell announcing no change in interest rates at 1.75% after 3 cuts of a quarter point apiece so far this year, but one data point that could still shape future policy is US consumer confidence. The latest reading from the US Conference Board is due on Tuesday the 26th of November. Now the last score was 125.9. So what, you may say, but that's way above the 20-year average reading of 92 and not a million miles away from last October's 20-year peak of 137.9. That suggests that US consumer confidence is way up, which is a good thing when you consider that the consumer and related services generate around 2/3 of US GDP. And if America's economy is strong, that should help to lift all boats on the same tide, as the US is the world's biggest economy. However, consumer confidence on that reading is still 9% lower than last autumn's peak, despite low unemployment and improved wage growth. This could reflect uncertainty over trade relations between America and China and the impact of tariffs. It could also be the result of increased volatility in the US stock market over the summer. Now that seems to have gone away, at least for now, and it'll be interesting to see if the new all-time highs in the Dow Jones Industrials, Nasdaq Composite and S&P 500 indices are prompting consumers to take a bit more of a rosier outlook on life. Now this chart plots US consumer confidence against the S&P 500 benchmark index. Which one leads and which one follows, I will leave to you to decide. But you can see why some strategists assert that the US is just one stock market stumble away from an economic downturn, rather than the other way around, as the loss of paper wealth could hit confidence hard at a time when households have taken on record borrowings of almost $14 trillion US dollars, according to the New York Federal Reserve. Now back on the home front, only 4 or 5 FTSE 100 firms are due to update investors this week, although a lot of mid and small cap companies are due to release interim or full year results, release a trading statement, or indeed host an analyst meeting or annual general meeting for shareholders. The names to watch could include Intertek, utility Pennon, real estate investment trust Shaftesbury, pork product specialist Cranswick, and also cybersecurity expert GB Group, all on Tuesday the 26th of November. Britvic and Brewer and Pubs Group Marston's on the 27th. Life insurer Phoenix Group, Go Ahead Group and Virgin Money UK, or CYBG as it used to be known, on the 28th. And newspaper publisher Reach, Trinity Mirror, as was on Friday the 29th. But for me, the stock most likely to cause a big fuss in the week ahead is British American Tobacco. The FTSE 100 member releases a trading update on Wednesday the 27th of November. Its actual full year results for the year ending December, well, they're due sometime next February. As we can see here, BAT shares haven't done that much over the past 12 months, although at least they're not down, which may surprise some of you given the negative headlines attracted by the tobacco industry on more than one occasion over the past year. Now, the headlines have included the ongoing pushback against smoking and tobacco by regulators and health authorities alike, and also the US investigation into vaping amid medical reports of vape users suffering from so-called popcorn lung. Now this means that volumes of the core cigarette business are coming under pressure, and the hoped-for growth generator, next generation products or NGPs, are already attracting scrutiny and in some places criticism. A relatively new Chief Executive Officer Jack Bowles, who took over from Nicandro Durante in April, has also responded to these challenges by announcing a 4-pronged simplification program in September, the net result of which will be the elimination of 2,300 managerial roles, or around 1/5 of senior positions within the company. The idea is also that the reduction in management layers, simpler processes and clearer business units helps BAT to reach its goal of £5 billion in sales from what it calls new categories by 2023-24. So, when it comes to the trading statement, the first 2 things that analysts look for will be an update on that restructuring program and an update on progress in new category sales towards that £5 billion target. Analysts will then home in on the 3 points of specific earnings guidance given by Mr. Bowles for 2019. BAT has targeted sales growth of 3 to 5% a year on an adjusted constant currency basis, and it's aiming for the upper end of that band this year. Within that, the company is looking for 30 to 50% sales growth from new categories on the same adjusted constant currency basis. Now, revenues from new categories, or NGPs, were £883 million in 2018, with 2/3 of those coming from tobacco heated products, THPs, and 1/3 from vapors. Secondly, BAT has guided to an increase in its operating margin of 50 to 100 basis points, or a half to 1 full percentage point. Now, in 2018, the operating return on sales was 38% on a stated basis and a mighty 42.6% on an adjusted basis. BAT has also guided to a high single-digit percentage increase in earnings per share, or EPS. In 2018, on a stated basis, EPS was 263.2p, and on an adjusted basis, 296.7p. Analysts and investors will then look for an update on the net debt position, which stood at £50.3 billion at the end of the first half, the legacy largely of 2017's $49 billion purchase of Reynolds American. The lower the debt, the better, not least as that will leave BAT with more room to pay dividends. The company is targeting 4 quarterly payments of 50.75 each, equivalent to 203p a share for the whole year. That's roughly a dividend yield of 7% on a share price just shy of £29. It also implies a flat dividend payment on last year, although analysts are still penciling in a small increase according to consensus forecasts. So let's see what happens on the 27th of November, but shareholders in BAT will be looking for some reassurance that after September's profit warning from Imperial Brands and Altria's decision to write down the value of its $12.8 billion investment in vaping leader Juul by $4.5 billion less than a year after it took the 35% stake. Thank you for watching, and I look forward to seeing you next time.